Imagine you've spent your entire career building a solid nest egg for retirement, only to watch it start shrinking just when you need it most. Sounds terrifying, right? Unfortunately, it happens more often than you'd think. It's called sequence of return risk, and surprisingly, many financial advisors don't even mention it. Today, we're going to dive into how this hidden risk can impact your financial future, and more importantly, how you can protect yourself. Hosts Jim and Ryan are excited to be joined by Denis Bisson, Portfolio Manager at TVH Wealth, who will share key strategies to keep your retirement on track, no matter what the markets throw your way. Together, they'll break down why sequence of return risk is so critical and how we address it in the retirement plans we build at TVH Financial.
Welcome to the show where we go deep inside the intersection of finance and the human mind. Jim and Ryan are here to guide. Get ready to explore, let's embark on this ride. Whoa, money, roots, and mastery, where we break it all down. Uncover the secrets, turn our eyes around. Get delved into the world where finance meets psychology.
At some point, we're going to actually have to get into it and start singing ourselves. How's everyone doing today?
Good. We're going to have to add one that has Denis' name in it, too, for the introduction.
Right, yeah, I'm only a regular. No?
He can be all Francais.
Hey, he can be our go-go dancer.
No, thank you.
No. Well, everyone, if you haven't guessed, it is the Money Mindset Mastery podcast. I'm your host, Jim Leo, and joining me today is my co-host, Ryan Genoe. Ryan, how are things today?
As always, beautiful day and exciting topics of navigating sequence of returns, which most people probably haven't heard of.
You're right. And Denis, you are our special guest again today. How are you doing?
We're doing well, and thank you for inviting me again. Look forward to this topic.
Yeah, and I think today is a perfect example of sequence of return risk where the markets have been flopping all over the place as well. And I mean, it's a short-term situation. But anyways, we're going to get into the topic, which is navigating sequence of return risk, the key to a secure retirement. And this is based on a blog post that I finally decided to write a blog post. So that'll be going out hopefully in the next couple of days. And we're finding that a lot of people, a lot of advisors are not really taking sequence of return risk into account when preparing retirement plans for clients or when establishing portfolios. So we're going to talk about what sequence of return risk is. Before I do that, though, I think I'm going to toot our horn a little bit here, guys. It's been a really good couple of weeks for both our podcast as well as for our YouTube channel. Ryan and I, we've had multiple unsolicited positive comments from clients and non-clients over the last 2 weeks. So it's telling us that, hey, we actually have listeners and viewers. And Ryan, I mean, one of the common comments that I know I've received and we both received today was the fact that they like the content.
And we're very handsome.
Well, they don't know that in the podcast, but the video for sure. But they like the content and it's not overly technical.
Yep.
So we're not going to get overly technical. However, Denis, when I proposed this topic today, you're like, might be a good idea to have some visuals. So surprise, I have some visuals.
Oh,
we're gonna go through that shortly. Unfortunately, for the people who are listening, you can't see them, but if you'd like for us to send you some of the visuals, just reach out to us. The first thing I will say, though, is if you are listening and you enjoy our shows and our episode, like, share, subscribe, do all those wonderful things for us. It does help us out. It does help share the knowledge that we have with more people. So please do so. So, guys, let's talk about sequence of return risk and what it is. So I think I'm going to start off with just the visual part of it first, and then we can kind of dig a little bit deeper there. So I'm hoping technology is going to work for me today because I haven't shared my screen on this platform in a while. I hit share. All right. You guys see that?
Yeah.
Yep.
Awesome. So let's explain what sequence of return risk. And I'm going to share a bit of a story here with everybody. So this is an example of an investor who retired in 1973. And you're going to see some numbers here and charts. In 1973, if I paint this picture for you, the investor retired with $1 million retirement portfolio. That's what they had in 1973. They put all their money in the S&P 500, and they had an annual income need of about 79,713. That's what they needed to meet their retirement income lifestyle. Over that 19-year period, I'm going to illustrate why 19 years. The average rate of return in the S&P 500 investment for this client was just under 13% per year. That's a really strong rate of return. Now, if you're someone who's watching the visuals, you're going to see there's an orange line that just keeps going down, 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 down. And what's that's basically illustrating that after 19 years, this person putting in $1 million, drawing $79,000 a year, and earning an average of, let's call it 13% a year over the 19-year period, they ran out of money. Now, if we look at the second line, the blue line, and on the right you can see it says 1991 to 1973. If we simply reverse the orders of how the portfolio received the rate of return or the average or performance, keeping everything else equal, all we did was reverse the order of the return, that individual would still have a portfolio value of $3.7 million after 19 years. So how's that possible? Well, let's dig a little bit deeper. And before I do, Denis, you liking the visual so far?
I do.
Yeah, awesome. Okay. So let's look at the chart here, sequence of return. Start from the left. You're going to see the column that says the year. So 1973 is the year the individual retired. At the beginning of that year, as I mentioned, they put $1 million in their retirement portfolio. By the end of 1973, the S&P 500 had a negative return of 14.67%. The individual still had to draw that $79,713 in income, and by the end of the year, their portfolio value was $785,000. You look at 1974, the following year, they started off with the 785. The S&P 500 had another negative return of 26.31%. They still drew the 79,000, and after year two, their portfolio of $1 million was valued at $519,000. That's pretty scary to see that, especially when you've worked so hard to set your money aside to live off of potentially for 25, 30 years, to think that you might potentially run out of money. And in fact, that's what happened here. So if we go from 1973 to 1971 or 1991, and you see the annual returns, there's actually only 5 years out of 19 that there was a negative return. So the majority of the time, the portfolio, the S&P 500, had a positive return. And yet, they took out $1.5 million of income over 19 years, and they depleted their capital. So now if we look at again, all the numbers being equal, everything the same, all we've done is we reverse the order of the performance. So we start off with 1991. So had the person retired in 1991 with a return of 30.4% by the end of year one, and they still drew that 79,000, their end of year balance would be about 1.2 million. And in year two, 1990, so now we're going reverse order, they started off with a 1.2 million value. There was a negative return of the S&P 500 of negative 3.10. The individual dropped 79,000 or drew 79,000, and they still had a portfolio value of a little over $1 million. And again, if you look at the numbers, they're just in reverse order. The same 5 years of negative returns. They took out the same $1.5 million of income. They averaged the same 12.98%, but they still had $3.7 million at the end of 19 years. I'm going to stop here for a second. What are your thoughts on this so far, guys?
It was a huge eye opener for myself, because being in this business for as long as I have, no one really walked through this, and it wasn't until I joined TVH Financial that we really started honing in and being able to explain to clients what the difference can be, and having multiple sources of income throughout retirement and not just relying on one single source, and especially being hit hard again. The most recent example in the last couple of years, which is the market was down significantly, and how it can eat away at your hard-earned money very quickly, very early, and that it's very hard to recover from that. And even though many advisors and many institutions will talk about, oh, it's a 13% return, right? But what is the sequence of how that happens and when you need it most? And that is one of the big things that differentiates us from a lot of other groups, advisors, institutions. We're talking about it because there's ways to navigate through the potential of this happening. And you may not retire on a high year, but that there's ways to make sure that we're drawing income from different sources and that we're actually truly diversifying what your actual portfolio is, and not simply just I'm drawing from my pension or my RRSPs and that's it, but we're creating a strategy that helps reduce your heartache basically from this happening. And I know, having worked with Jim, your clients, over the last couple of years, just the gratefulness that I hear out of their voices when they talk about you being able to put them in this type of position where they were sleeping fine at night. And for those clients that have advisors that aren't talking about this, come talk to us, because then we can help truly diversify instead of just putting you in diversification based on some small little risk assessment that, because you're in a shorter term or a long-term investment, that it's not all based on one particular market. And that's one of the biggest eye-openers that I've had over the last couple of years. And as I continue to teach and coach and truly diversify clients' portfolios in a way that they won't see this type of thing happen, because it happens to people. It happens to a lot of people.
Denis, how about your thoughts, if any?
Well, I think Ryan hit it on is diversification of the portfolio. If you're going to invest, like everybody thinks an index fund is fully diversified, I don't need to do anything else. And a lot of people say, why don't I just buy the S&P 500? Look at this return. Well, look at the sequence of returns. And we know, I wasn't in the industry. I'm not that old, in the 70s, but I know it was a bad time in the markets. 2022 was our most recent bad time. 2023 without AI would have also not been as good a year as it was. So without the AI, we could have had struggled for perhaps 2 years. 2022, very bad. Basically, the S&P 500 down about 19, TSX down about half that. Fixed income bonds, the universe bond was down double digits as well. There was really no hiding on that. I know some people that just postponed their retirement because they were aware of this. Others, they started off, but they took out a little less. It's important to understand, or at least to have an advisor to talk about something like this. $79,000 is not a small amount to withdraw from a plan, even though $1 million is a nice retirement plan, and most people wish they had $1 million, but 79 is a fairly big number. So that you have to be careful on that. That portfolio should not have the volatility of the S&P 500, despite the good long-term returns. And there's diversified portfolios where you still get that upside without the heavy downside or potential downside. 2022 cash was the only thing that was up. So you need somebody, some managers, and that's when you get to alternatives that still manage to have positive returns when everything else is down. But what you don't want is volatility. You want to minimize volatility, especially when you're starting to take money out. And that's what pensions do. because, look at the teachers. They're going to have more retirees than they're going to have working teachers soon. They need to be careful that the money's coming out. They have to diversify, look for some returns, obviously, to grow their assets, to make sure teachers don't have to put more in. But at the same time, protect the downside. They know that money, once it's taken out, it's gone. There'll be nothing there. It won't be there when the markets recover. So you're left with a smaller pool. And that's what we saw in your example.
Yeah, and really what it speaks to is knowing when the markets are going to perform a certain way, and that's the challenge. No one really knows. Correct. I mean, I think Ryan and I, we're still waiting for that crystal ball from Amazon to show. Yeah, we're still dealing with some issues with delivery and stuff like that. So it's very difficult to predict the future, and that's the problem. Like, if you're just relying on performance. And this is where I get frustrated a lot of times when I deal with clients who are working with other advisors. And not all advisors are this way, but there are a lot that are. All they're focusing on is what's the fee? What's the performance? What's the best stock that we hold in our portfolio? They're focusing on all those things and not really protecting a client in the event that we have a black swan event like we've had recently. Right, or that, as we say, the punch in the face type of situation, right? So one of the things that we definitely don't lose sight of is sequence of return risk. That's our number one focus when we put a plan in place for a lot of our clients, because we don't know what the future holds. And if you want to make sure that you can retire and being able to sleep at night, like you said, Ryan, which a lot of our clients can sleep at night, you need to change your methods. You need to change your strategy. And you have to really consider sequence of return risk as a big one. And in terms of a pitfall, what happens if all of a sudden you don't have that strategy in place? And we saw what happened in 1973, 74. It can happen again. It has happened. The bottom line is you can't retire, or you're delaying retirement. Mm-hmm. And even using the number, Denis, that you mentioned, like $1 million, if we have the numbers, if you had a $500,000 portfolio and your need was only $40,000 a year of income, after year two in that scenario, your portfolio would be worth about $250,000.
Yeah.
That's a scary, scary thought. Right? Ryan, were you going to say something?
No, it's just a consequence of not preparing yourself for anything. And yes, as I've said before, the great philosopher Mike Tyson says, everybody has a plan until they get punched in the face. And we're trying to make sure that we're creating a proper plan for people when it comes to this. And that I say it again, we are talking about it, which often many people are not talking about because they're blinded by a return. They're just looking at a return, and that they hope that return is going to continue forever, right? So
yep. Denis, what are some ways that an individual can protect themselves from the sequence defense risk?
Well, one of the things you do want to do especially when you start taking money out, is bring down your risk level. You're starting to take money out. If you're at growth, well, maybe it's time to go to balance or even conservative, depending how much you're taking out of your portfolio. There's minimums, but some people take higher, a larger percentage of their accounts than others. So we got to look at that. Communication is key. You got to see what's going on in the market. Diversification, and at TVH Wealth, as you know, we manage money very similar to a pension. So when markets are down, we could allocate more to certain managers that flourish when markets are down. They're absolute returns fund. They will short sell. They'll do small things. Now, it's not a big allocation, but it is protection. You don't want the big ups everybody will take the big ups. It will limit the big ups, but you'll definitely limit the big downs. What you want is steady return, adding to your portfolio. So that's one way of doing it. So it's a combination of making sure that portfolio is diversified and the type of investments you're in. Like I said, 2022, there was no hiding unless you were in cash. Everything was down. So a lot of people think bonds, I'm in bonds, so I'm fine. Well, you weren't fine in 2022. this is where you need those alternative managers as part of your portfolio to help. Again, diversified portfolio. So not just one, diversified portfolio to help with the returns, go down less. Was the portfolio down in 2022? Yes, it was down about 4%, but that's a lot better than, the 19 on the S&P, the roughly 9 on the TSX, and the double digits on the bonds. So there was less movement there. So I think that's the one thing to look at.
So one of the things that I want to ask you is, how often do you recommend clients revisit and adjust their retirement portfolio?
Well, one of the things we do, I have to have an annual meeting with my clients. And every time we talk, we do review the investment policy statement. Has anything changed? Are you still comfortable with this risk? Because they answer risk questions that could have been 5 years ago, and every year they say, okay, no change. Nobody ever says anything or complains when the market's up. But when you get the volatility, that's when people start maybe second guessing, and that's when it may be worth a conversation. I see time horizon, I see the money, I see how much they need, what they have left. I can make recommendations as well. We're a little too aggressive now. We're coming into very uncertain waters. Interest rates are starting to increase, for instance. Let's revisit the risk level and talk about it again, because we may see more volatility in the coming year.
Do you see any big mistakes that retirees are making right now when it comes to planning their withdrawals?
No, not necessarily. Most of my clients and a lot of people I see are taking minimums out. They're keeping an eye on it. And the one good thing in the rising market, you could take out your minimum RIF withdrawal once a year, and the funds grow back, and that's you're at the same level or higher after the withdrawal. That's an ideal situation. When it's not so ideal, obviously you take it out and you have a lot more than your withdrawal. So some of the mistakes, I think some people may panic and just go into cash. And that's the conversations we need to have. I want to can that happen? We do have preservation funds where we will be obviously a little more on with the alternative managers in some cases. But we definitely need to get a feel on the risk level and their ability to potentially go down a little bit and chance to recover. Some people, if they go down, there's nothing left. Not everybody has a defined benefit. If if they're invested in the fund, they need to see some growth to help with their retirement lifestyle. That's when you need the conversation. Let's try to protect some of those assets, because you don't have another pool. There's not a pool of non-registered, or you don't have a big TFSA. So we got to be careful on the RSP. That could have been a defined contribution before, part of their work plan. So you got to be careful on that, and really open the communication and talk them through it. Let's not get surprised, I think, is the key here.
Something I wanted to add as a quick sidebar, because I just had this conversation with a couple clients, was understanding the difference between, and I don't want a huge dialogue, but RSP and RIF, because some people still don't understand that, and even LIRA or LIF. Can you just very quickly tell people what that is?
Well, when you're retired, and it's not necessarily the day you retire, when you decide you need money from your RSP, it could be at 65, you have to do it by 71, that RSP gets transferred into a RIF, and that's when the withdrawal starts. So you take out your minimum, you don't get tax charged. You take out more than the minimum, there will be taxes charged, but in the end, you do report it on your T4. And that's the same with a LIRA and a LIF. So it's the same thing, but it's a locked-in plan. So LIRA is a locked-in, probably came from a prior pension. You really can't take money out of that because it is locked. So when you turn it into a LIF, it's the same thing as a RIF. You will have minimums to take out, government-mandated minimums, same as like a RIF. But you could take out to a little more on a locked-in income fund. There's a limit on how much you can take out, but there is a range, which I think is large enough for most people. You have your minimums, and then when you find the need, you need to take it out as part of your retirement income to add to your CPP and OAS. It turns into a LIF. So LIRA to LIF, RSP to RIF.
And I think a lot of people don't realize that the government sets the mins and the max on what you can pull out without.
Yeah, on the LIF.
Yeah.
On the RSP to RIF, there's no maximums. It's
Yeah.
your money. All they're going to do, the more you take out, the more they tax you.
That's a question I was going to ask too, the surprise question. Are you taxed on that money that you draw from your RIF, LIF, LIRA, or RSP down the road?
Yes, fully tax
Yeah.
every penny as income. TFSA, you don't get a tax receipt, zero tax. So the RSP, if you're taking out from an RSP before converting it to a RIF, you'll get taxed when you take out the money, say if it's under 5,000, 10%, and then you'll have to declare it as income because you'll get a T4 RSP. So same thing on well, the LIRA you can't really take out unless you're there's some
Hardship.
reasons out, but
Yeah.
hardship. But it's the same when you get your LIF, fully taxed as income payment. So OAS, CPP, and LIF payment will all be fully taxed as income.
Yeah,
That's
I
why it's
asked
good to
that
have.
question not because I didn't know the answer. It's because it's amazing how many clients that I get in front of who believe that once they retire, all that income is tax-free. They pay zero tax on it. So it's just amazing how many people don't understand the tax liability that they've potentially created for themselves by putting most of their assets or investments into an RSP, for example. And then when we talk about at the estate level what happens, they are floored. And there are strategies that we can, access some of the capital at a preferred tax rate or zero tax rate. They're all over YouTube right now. I'm seeing them, and I would say that they're definitely higher risk strategies and not for everybody. And we're not going to get into that. But yeah, it's amazing how many people don't understand the tax issue that they've created for themselves.
And that hits our topic right on. Once the RIF is open, you have to take a minimum out. So even if the markets are down, your minimum's coming out. It is government mandated. So there's no hiding from it. When it's still an RSP and you're not taking money out, obviously you don't touch it. But once you retire and you convert it once it's converted to a RIF, the minimums come into play. So that's why the diversification, the conversations, and everything else is very important because you have no choice but to take it out.
Right.
And our RSP, the joint account with the government. I actually had a question because it came up, and I think it came up before with a client that was a little shocked when it came to signing off for their LIF, especially people who were married, that the spouse had to sign off on the paperwork that they agreed that the money was coming out or something like that. Can you expand a little bit on that about spouses and the control of your money?
Yeah, again, because it comes from a pension. And don't forget, a pension, if you pass away and you're collecting a defined benefit, 60% goes to your spouse in a lot of cases. They continue to receive the defined benefit. And that same philosophy applies to a LIRA. You cannot change the beneficiary. It's mostly, and your spouse does have to sign the forms. So unless, of course, divorce or anything like that. But it's the same understanding where a defined benefit, you pass away, it continues to go to your spouse. Depending on what you signed off, whether you're a teacher, whether you work a government worker, it'll tell you how much your spouse or a healthcare worker that I just worked on, it'll tell you how much your spouse is going to get. Some it's 50%. Some it's lower because you're taking a higher portion. So you're getting a higher amount, but your spouse will only get, say, 50% were you to pass first. So that's why they apply that same theory a little bit to the LIRA. Most provinces have something similar, but there are differences. Ontario, you need that signature. I signed my wife's, she signed mine. Everybody's happy.
Because your spouse. Getting back on track, right, Jim?
Well, I was just going to say now, let's get back on track to what the topic in hand is, which is sequence of return risk. So there are strategies. So, Denis, you kind of shared a layer of protection in terms of the diversification piece. There is a strategy. We don't want to give it all away today, but we employ what's called a sequence defense strategy. And within the sequence defense strategy, The one layer for sure is the portfolio construct, right? And the level of diversification that's offered through TVH Wealth. We also believe in creating some guaranteed income sources in retirement. So not everyone has a defined benefit pension plan. You work for the government, you do have one. You work for a private corporation, about half the people may have one, and the other half will not. And what's happening now too is we're starting to see some of those private corporations moving on from a defined benefit plan to a defined contribution plan because there's a liability to the corporation or the pension if they don't have enough funds to fund the income, right? So we do have access to programs that do offer a guaranteed level of income. And where that protects you is doesn't matter when you choose to retire, doesn't matter when how the markets are performing. If you have a part of your portfolio into a guaranteed income source that are at the very least covering your fixed retirement costs, you don't have to worry, right? So that's one of the two things that we employ. There's another strategy we employ as part of the sequence defense strategy. If you want to find out what that is, look us up at tvhfinancial.ca or call us at 647-727-4668 or email us at financial@tvhgroup.ca. And we'd love to schedule some time to discuss what the full strategy is to protect yourself from sequence of return risk. Now, I've had clients when I've presented this strategy and this level of risk say to me, well, when's that ever happened before? Well, 2008 was a perfect example, right? When everyone thought that the world was ending and all the banks were going to collapse. I've known clients who became clients of mine after the fact where their portfolios were wiped out 50, 60%, depending on what they were invested in. They had to delay retirement by 5, 6, 7 years because it took them that long to either break even and then to increase the value of their portfolios as well. So we've seen it happen. 2001, that was a scary time. We've had 2022, that's a very recent one. Even during COVID, I had a client of mine who called me because I believe it was March and April where the markets really took a big deep dive. And I employed the strategy for her. And I remember her calling me and she said, Jim, I wasn't a big fan of the strategy when you recommended it. I still went ahead with it because I trust you. She's like, now I see the value in what you did for me because I'm retired and and this client was generating about $100,000 a year of retirement income from the strategy that we put in place. And she said, I'm going to get my $100,000 this year no matter what, and I don't have to worry about running out of money because of the strategy you've put in place. However, I have family and friends who are in a situation that I'm in who have lost a significant amount of their portfolio value. They're freaking out because they're afraid they're going to be running out of money a lot sooner rather than later. Mm-hmm. So it was nice to get that phone call from someone to say, now I get it. Even though I wasn't a fan of it, now I get it, right? And even to your point, Denis, everyone's happy when the markets are up. I think we show our value when the markets are doing some crazy things on the downward side, right? People are usually happy that we've protected their capital as best we can. We've kept it intact for the most part, compared to being in an index and all of a sudden seeing a 35% drop, because we've seen this a lot of times in our meetings. Everyone's a higher risk investor when they're generating those high returns. But man, oh man, do they go conservative all of a sudden once things go in the opposite direction, mm-hmm. Right?
Yeah. So. You made a good point on diversification and the right portfolio. I know during that 2008 period, because I worked for an asset management firm, I used to talk to a lot of brokers that some of them had their clients in, at the time, those type of boomer economics funds. and they lost. They got hit really, really hard
Okay.
because that was one of the parts. Whatever goes up most comes down the most. That was that was a hard hit for them. It was a chance. They were in their, again, late 60s, early 70s. They had no chance to recover because they had no more income coming in, and they weren't really going to go back to work, at 69, 70. And they just had to deal with a much smaller pot in the end.
Yeah.
The right portfolio is key.
The right portfolio, the right investment as well. We have a lot of clients that probably put a little bit too much of their assets in real estate, for example. And I'm not going to sit here and say real estate is not a good investment, because I believe that it absolutely is as part of an overall portfolio. But I definitely know of enough people who have just said, I'm just going to keep building my rental portfolio. And now they require access to the capital, and they can't sell their real estate assets because of the current market cycle that we're in. And I think we're getting out of it now. But it's something we've been dealing with for about 1.5 to 2 years. And some of them are also selling at a lower value than what they could have gotten 2 years ago, or what they were counting on, right? So this is why we stress diversify, diversify, diversify. It's the reason why we founded TVH Group all those years ago with John, because he recognized if you put it all in real estate, you're going to have some problems if you need liquidity and you don't have that in your plan. Mm. And I recognize that you need real estate to kind of smooth out your overall return as well long term. So it is definitely diversify, but also establishing some of these other sources that we've talked about that we would be more than happy to share on a one-on-one meeting with a client.
Yeah, there's clients, your coworkers or your neighbors that are all happy when the markets are doing well and they're telling you about their big returns.
Yeah.
Have that conversation with them when the market is down, and do a comparison of how if you follow a great diversified plan, how happy you'll be in the down markets, and how they don't talk at all about how they're doing. But it's a great opportunity for you to potentially talk to them about who you're working with, and TVH Financial and TVH Wealth. Great.
Well, gentlemen, I think we're going to start wrapping things up here, unless there's some final comments, thoughts to share. Ryan, you good?
Yeah. Diversify the right way, and give us a call.
And Denis, how about yourself?
Yeah, well, it's very similar. When you're starting, especially when you're starting to withdraw, the less volatility, the better. You do not want the big ups and downs, because if you're withdrawing on a down, that's not a good thing. So less volatility.
Yeah, it's the reverse of dollar cost averaging, right? You're accelerating your losses essentially if you're drawing when things are going down significantly. So, all right, guys, there's another one in the books today. Once again, look for us at tvhgroup.ca. That's where you're going to see all the different departments that we and services that we offer, and you'll find Denis there through TVH Wealth. You'll find Ryan and I through TVH Financial. And until next time, have a wonderful day. Thanks, guys. Take care.
Why